Bethany Welsh, and I am a Treasury Management Officer at our Iowa City Town Gilbert Street location. A few housekeeping items are as follows. Restrooms are out this door to your left. There are a few handouts at your seat. Those include a list of Business Academy seminars like the one we have today, and a survey to fill out after the event today to help us provide feedback for future programming. We'll get started shortly, and we should wrap up by about 11:30 this morning. On behalf of all of us at Hills Bank, we appreciate you taking the time out of your busy day to attend and gain new information to help you and your business succeed. LattaHarris has been a wonderful partner of ours, which is why we were able to offer not only one, but 2 sessions of the 2017 Tax Cuts and Job Act seminars in the corridor. Now please help me welcome Chris Overture from LattaHarris.
Thank you. Like Bethany said, I'd also like to welcome you. Thank you for taking a couple hours out of your day to come and learn about the new tax law. I had the pleasure of introducing Roger McEowen. Roger's been a great friend to our firm for a number of years, and he's got a very lengthy bio, but I know you're not here to listen to me read it, so I'm going to give you just a very short and condensed version of it. Roger is currently the Kansas Farm Bureau Professor of Agricultural Law and Taxation at Washburn University. Prior to that, he was with the Director of the Iowa State Center for Agricultural Law and Taxation, you might know as CULT. That was in Iowa State University in Ames. It was a great program. It was fully funded its operations and took no taxpayer money for all the great work that it did while he was there. Published numerous scholarly articles, written in many college textbooks. Basically, this is the guy you want talking to learn about the new tax law. So we're very pleased to be able to present him to you today. So, like I said, you're not here to listen to me, so I please help me welcome Roger to the podium.
Could you do me a favor?
Yeah.
There was a sheet up here.
Oh, the one I just took?
That might be the one, yeah. Yeah. That's what I'm talking about today. Okay. Thank you. It's good to be here this morning. It's great to see such a good crowd that's fired up to learn about tax this morning. So 2 hours of tax. But I do appreciate Hills Bank sponsorship as well as LattaHarris, so we thank you for that. And make sure you got contact information. This is on the front page of the handout for you. It has my email address at the law school, my website address, and if you're into Twitter, follow me on Twitter. I use all of these tools, all the social media tools that are out there, plus Facebook to convey tax information. On my website, that will give you access to my blog, which is on the Law Professor Blog Network. It's the Agricultural Law and Taxation blog, where I'll produce 2 to 3 times a week a detailed tax or legal article related to something to do with agricultural law. And those are not just short snippets, those are lengthy articles of about 1,500 to 2,500 words with annotations. And if you're a practitioner, you can run those annotations and it'll help you in your research. I spent a lot of time doing that, and hopefully you'll find that helpful. Also, I'm on RFD TV at least once a week, plus various radio programs on my website, and that's the homepage again. Those podcasts, whether it's TV, whether it's radio, you can find those links on the website. So in case you would miss those, you don't catch it on Sirius Satellite Radio or on RFD TV or on the various radio programs that I do, they're all captured and they're linked for you on the website with a brief summary of what I'm talking about. So you're not just kind of snooping around blind, trying to figure out, well, what did he talk about on this date? There's a short synopsis of the issues that I'm addressing on any particular program. So take a look at that. There's a lot of information on the website that's there for you. What we're going to take a look at in the next 2 hours is just kind of a summary of where we're at with the new tax law, the Tax Cuts and Jobs Act, and I'll also make comments with respect to the new Iowa tax legislation, which is cumbersome to say the least. I'm trying to be as polite as I can with respect to that, but if you're preparing returns, it has made life more complex. And the fact that many of the changes are just on a one-year by one-year basis makes it more difficult to deal with too. But we'll get into that as we go throughout the discussion. As you have questions this morning, feel free to raise those questions. We won't try to hold those to the end because I want you to ask questions as something comes up and you have that so that you don't forget about it and then have to wait to the end to raise the question. So feel free to raise the question. We'll try to have a free-flowing discussion. as we go throughout. The other thing I would mention, I neglected to put page numbers on your material. If you want to just handwrite those on there, that might be helpful because I'll refer to page numbers as we go through. They're front and back, so as you flip pages, it'll be 1 and then 3, and then flip it over and get the even numbers on there. So there are 23 pages in total, so that might be helpful to quickly find things as we go through the discussion this morning. I'm going to start, the first part will be just kind of an overview of some concepts in general that are not necessarily in your material, although they're referred to in other places, because in other things that I'm going to be talking about, I'll refer to these things initially, but in terms of in your document itself, these are not there. So if you have a separate notepad, you might want to have that available too. You can take some notes or write in the margins on your paper, but if you have a separate notepad, that would be helpful too. So let me get started and make a couple other comments. This is a summary of what you will find on the website, and it just kind of summarizes all types of things, my books, the blog, the continuing education. I normally do about 80 to 100 seminars like these, anywhere from an hour to 8 hours a day in terms of continuing ed, 80 to 100 of those a year. This year it's going to push 120 because of all the new tax legislation. I had Pennsylvania last week, 2 full days, so 16 hours of lecturing in Pennsylvania last week for practitioners, as well as that was live audience in Pennsylvania plus the webcast. And this week, next week, I'm in Kansas, and Las Vegas is coming up, and so on and on and on. The show goes. But you'll get the complete list of what's upcoming, radio programs, RFD TV, the articles page on the website, all types of things there. If you're not familiar with that, I would encourage you to play around with that and see what you can find. I've got a new book out, and that's called Agricultural Law in a Nutshell, which is a desktop version of my big treatise, Principles of Agricultural Law. The Nutshell is published by West Academic Publishing Company out of St. Paul, Minnesota. And I think it's a handy reference for those of you that are involved in agriculture. And just about everybody here is in one respect or the other. You may want to take a look at that. Ordering information is on the website too. In terms of, let me just give a quick promo of what we're doing at the law school. These are the ag-related courses that we teach at Washburn Law School. This is more expansive than any other law school in the nation. There are 3 of us that teach the ag-related courses. Now, of course, a student's not going to get all of these in a semester or in a year. This is what's available over their course of 3 years. I teach many of these, and primarily I'm teaching 3Ls, the last 2 semesters before they return them loose to practice on people. But we're heavy, of course, in Kansas on oil and gas, and we probably have the nation's preeminent law professor on oil and gas, and David Pierce. Water rights and lots of things to do with water. Of course, that's a big issue as you get further west. Bert Griggs is our professor that teaches a lot of the water issues, and he represented the state of Kansas in litigation against Nebraska and Colorado over the Colorado River water compact, and won that on behalf of the state of Kansas, and at the U.S. Supreme Court level. So he's very gifted with respect to water law, but I teach a lot of these: the farm bankruptcy, the farm and ranch taxation, farm income tax planning and management, ag contracts, agricultural law. A lot of those are the ones that I teach: environmental regulation of agriculture, of the oil and gas industry. So there are a lot of things there. Plus, we have Indian tribes in Kansas. We have quite a lot of courses that subject matter that they can take on tribal law and government. And not all of these are 3 credit-hour courses. Some of these are 1 credit-hour courses, specialty courses, but we're very practice-oriented with respect to the students. And we have a rural law program. This summer, for example, we're placing 20 students with attorneys in a 26-county area in western Kansas at no cost to those attorneys. That's funded by a major grant from the Dane Hansen Foundation. We had 13 we placed last summer. It's 20 this summer. We're trying to repopulate the areas of western Kansas and western Nebraska and parts of Colorado and out into Wyoming and the Dakotas and Montana in areas that are underserved with attorneys that are well-versed in legal issues that impact agricultural clients. So that's what we're doing at the law school. So if you have somebody in your family that's interested in these topic matters, have them drop me a note, and we'll share more information about the law school with them. All right, let's get into the material. Now, this is not on page 1. This is kind of background information that sets the stage. When we look at the new rates under Tax Cuts and Jobs Act that is effective beginning January 1 of this year, current law means old law now. Current law in this context means the law that was being used to prepare the returns that were getting filed this year, so it's 2017 law. Tax Cuts and Jobs Act is on the right-hand side. You can see for a single filer, we still have 7 rate brackets. 10% is the beginning, current as well as or old as compared to new, but the top end's at 37%. And there's a little bit difference in between in terms of your rates and where the brackets cut. For married filing jointly, here are your numbers with respect to the rates as well as the bracket amounts. I think what's most helpful is to look at it like this. This is more helpful in terms of just the numbers. When you look at the top 3 sets of bars, this is married filing jointly. The bottom 3 sets is for an individual that files as a single person. And what we're comparing, the second blue line in each of these sets is the new law compared to what the law was through 2017. Now it says current, but that's now not current, that's former law. And in between we either have green, white, or red. Green means new law compared to prior law, green means that your rate is lower based on this income level down here. So you read your taxable income level down here and you read it up. And this range all the way up to about $400,000, your rate is lower on married filing jointly. Then there's a little sliver where your rate's higher because now you see the new bracket amount start where we start the 35% range is right here. It is a little bit lower than where the 33% used to end. So we want to stay out of that. We want to utilize tax planning techniques to stay out of the red areas. We want to manipulate taxable income to the extent we can to stay out of this area right here, about 400 to 410, 415. Then the next little sliver here, 35 is the same as 35, so that's white, there's no change. And then 35 is less than what the old rate used to be, and 37.6 is still less than, or excuse me, 37% is still less than what the old 39.6 is. You understand how to read that? Now, when you look at a single individual, look how much more red you have here. All right, a lot more red here. You got a little glitch right here where it's green. That's because the 32% rate is now less than where the 33% rate used to reach back to. Then it turns red again because 33 was less than 35, but then your this picks up 39.6 here going out, and 35 and 37 are less than that. So you want to stay out of these areas as a single individual unless you can land in this sweet spot right here, right around a little under $200,000 for a single individual. So up to about 180, 175,000, your rate is lower now. Then it turns higher, then you get a little sliver where it's lower again, then it turns higher until you get up to about $450,000. Not quite 450, a little less than 450 on up, then the rate is lower again. Any questions on that? So what you want to do, what you want to think about generally as tax planning is to use tax techniques to the extent you can to stay out of these ranges right here that are red. Now, let me throw one other thing in there on this. There's something known as the Pease limitation. Pease is named after a former congressman. But this is a phase out of itemized deductions based on income. This has been removed. So what this used to be was an additional, we think of it as a surtax, but since it's been removed, that's an additional tax cut for higher income earners. It's basically about a 1 to 1.2% surtax on higher income earners. Now, as is the case with most things under TCJA, it sunsets after 2025. And this is just because of the rules in the Senate. They couldn't get 60 votes to do this, so they have to sunset the law. Sunsets after 2025. So we still have to know about this stuff in case temporary actually means temporary. And we go back to what the old law used to be. So when you factor in the removal of the Pease limitation, now here's what your charts look like. This is official now, because this incorporates in the removal of the Pease limitation. So married filing jointly, you're lower on your rates all the way through. Not so for single individuals. Again, we still have this little bit of range in two pieces here, a large piece here, a small piece here, where your rate structure is now, your effective rate's, your applied rate is higher than what it used to be. Okay. All right. Now, estates and trusts, and I'll come back to this with respect to the first point on page 1 of the materials with respect to gifting commodities. For estates and trusts, because there's an application to commodity gifting in agriculture, look at your rate brackets and your rates. Very compressed. That's the way it used to be, that's the way it remains, but you're going to hit the top end of 37%, the top rate of 37%, once you get to $12,500. So income in an estate or a trust is taxed at the top rate of 37% once you get to taxable income in the estate or trust of $12,500. We normally, in the normal course of things, would not want to have income taxed at the estate level or inside a trust. It's usually going to be more beneficial to distribute that income out and have it taxed at the beneficiary or recipient's individual income tax rate, which is likely to be lower than 37%. Now, the way they did some other things in TCJA, this does have an implication with respect to commodity gifting in agriculture, and a very negative implication in many instances, and I'll talk about that in a moment. What about capital gains? Any change with respect to capital gains? Basically, no. No change on your rate structure with respect to capital gains. As you note here, the bottom two bars are Tax Cuts and Jobs Act. The top two are prior law through 17. There's really no change. Congress did not remove the net investment income tax, and so that's that additional 3.8% tax on passive gains that was included in as part of the health care law and took effect starting in 2013. We knew last summer it was not likely that that was going to be removed, and indeed it was not removed. That's the net investment income tax for the tax preparers here, that's section 1411 of the code. That stays on, so you see the tack on of 3.8% to get you to 18.8 to 23.8 on your passive gains. So passive gains, if you have individuals up above a certain level of income, you can see where that kicks in, are going to be, it's at 250, so that's why you see the additional 3.15 goes to 18.8 at 250,000 for a single individual, or excuse me, married, filing joint individuals, 200,000 for single. Okay, individual AMT. Now, the alternative minimum tax, Senator Grassley has pushed for many years for an elimination of the AMT, which basically is you're going to do two computations. You're going to compute your regular tax, and you're going to go back and recompute and remove a bunch of deductions that you're otherwise able to claim, and recompute the tax based on your alternative minimum tax, pulling out a lot of those deductions. And that has gone from affecting just a few hundred taxpayers in the 1960s when it was first enacted to over 30 million taxpayers. Well, that's reined in by an increased exemption. You can see the old one was 86.2 on a married filing joint return. The new is now 109.4. But the big deal here is that your phase-outs are higher. We go from married filing joint 164.1 to $1 million. So it's going to likely eliminate AMT for most farmers. I don't think there'll be very many farmers that will still have AMT. For the tax preparers that are here, would you generally agree with that? Have you done enough projections to determine whether you will still have some farm clients that will be subject to AMT? You say no. I think it pretty much wipes it out. It doesn't repeal AMT, but effectively we kind of get the same result. Okay? Kitty tax. And this is a lead-in kind of to what I'm going to talk about with respect to commodity gifting. The old rule was that for kids, defined as under 19 or a full-time student under 24, they're taxed at their individual brackets for earned income, but unearned income above a threshold, which was $2,100, was added to the parent's income and taxed at their top marginal rate, so it's taxed at the parent's rate. New law, and here's the kicker, child's unearned income is subject to trust tax brackets. So you don't get the parent's rate, you're going to hit 37% on unearned income once it hits that 12.5. That has serious implications for commodity gifting, and I'll explain that. But basically what it is in a nutshell is that if you're making large grain gifts to your kids, for example, you're going to face an increase in the tax rate from what used to be a range of about 12 to 22% to 37%. You do the math on that, that's about a 70% tax increase. Right there. That can lead to an additional tax liability in many situations. Now, you're still going to save on SE tax, and that's why we do commodity gifting in many instances. We do save on the SE tax. That's still true, but now you have to balance that against a much higher rate on the unearned income of the child that exceeds 12.5. That's the new math that you're going to have to go through in determining whether you want to continue a strategy of gifting grant. Standard deduction, what happened here, basically a doubling of the standard deduction from 13,000 married filing joint to 24,000, 6,500 single to 12. And that's going to be adjusted for inflation starting in 2019. Now again, it sunsets after 2020. So a lot of times I get a question, well, what's the zero tax amount? How much income can I have before I have to file? What's the zero tax amount? It goes up. 2017, last year on a joint return was 20,800. That's your zero tax amount. This year would be 24,000. Last year, 10.4 single. This year, 12,000. So kind of gives you an idea of what the zero tax amount is. Often that's important for children that have jobs but wonder how much, what's the ceiling before they would trigger tax. Those are your new zero tax amounts. Adjustments for inflation. This is another one, it comes up at different points throughout the outline. I just want to plant the seed in your mind at this point in time. We used to adjust a lot of things, the brackets and credit amounts and so forth, for inflation. We have inflation adjusters so that the set amounts would not be eroded over time by inflation. So we continue to adjust them up. And that was that we look at the CPI, Consumer Price Index, to do that. Now it's known as the Chained Cpi, and this is something the Treasury has been pushing for a couple of decades, and they got it under TCJA. And basically what happens under the Chained Cpi is as you have inflation in the economy, you get less of an increase in your adjustment. The adjustments, the inflation adjusters don't go up as much. So effectively, that's a hidden tax increase. And over 10 years, and it was scored that way by the Congressional Budget Office, this was deemed to be a revenue offset. The effect is going to be about 3 percentage points. So it's an indirect tax increase, the way that they're doing the inflation adjusters. You will not see things adjust up as much as they have in the past for inflation. Repeal of the individual, should say mandate. This is healthcare law, and this gets misconstrued by some of the politicians and the media. Yes, the individual mandate is repealed. That requirement, that additional penalty tax, I call it the Roberts tax in honor of Chief Justice Roberts, because if it weren't for him, we wouldn't have this tax. That is repealed, but not until 19. So it's still in play for individuals through 18. Okay. Now, for applicable large employers, it's still there. If they fail to offer minimum essential coverage, that's MEC, to their employees, they still may be subject to the tax, under their taxes at 4980 cap H of the code. Your applicable large employer, the cut line is 50 full-time equivalent employees. So once you get beyond that, then the penalty would still apply. But it is repealed for individuals starting in 19, still there for 18. Okay, we'll skip that one. Alimony issues. Again, not in your material, but I just kind of want to give you a survey of the surface here. I would say probably purely from a tax standpoint, if you want to get divorced, do it this year. Don't wait until next year. Why? My wife hates that one. I did a blog post on this too, and sometimes she proofs those. She happened to see that one that day, and she said, "So I need to act this year?" Don't take my stuff personally. I don't apply it personally, but I guess if you're thinking of it, then yeah, the rules are going to change starting in 19, because in terms of alimony, there will be no deduction for payments made under orders executed after 18, or modifications made after 18 if the modification expressly provides that the repeal applies. Now, there's no inclusion starting in 19 of income for the recipient spouse. So no deduction for the person paying it, no inclusion of income for the person receiving it, starting in 19. And that's just the opposite of where we're at right now. Okay, we've got an IRA deduction provision that stays the same, but the rule that permits contributions to a non-Roth to be recharacterized as contributions to a Roth, that was repealed. So talk to your financial planners about the implications of that in your personal situation. Also, there's another rule in terms of retirement plans that provide loans to employees, and what the new law does is extend basically the existing 60-day period you have to do this a little bit further. It extends the time frame for contributing the loan offset to an eligible retirement plan. That's not applicable to everybody, but certain types of retirement plans allow those types of loans to employees. Now you can roll that tax-free to another eligible retirement plan. The rule used to be you had to do it within 2 months or 60 days. Now you got a longer time frame to do it. Kind of a minor point, but that's another one of those things that if you have the type of retirement plans that allow that, you want to talk to your financial planners about that. Student loans, loans that are discharged due to death or disability will no longer be treated as taxable income. Now, that does not affect any other federal programs where discharge is taxable, but that is one change that they added 108F5 to the code on that. Moving expenses, this is a biggie for many people, and this is a game changer for some. This is a big deal for employers where employees move. The deduction for moving expenses and the exclusion of qualified moving expense reimbursements are suspended for tax years 2018 to 2025, so they're gone. Now again, this is one of these things that sunsets, so it comes back in 2026 if Congress doesn't do anything. The only exception here is if you're in the military and you move pursuant to military orders, you're on active duty, then you still get to deduct your moving expenses and you get to exclude qualified moving expense reimbursements that the employer would provide. So if you're not military on active duty moving in accordance with orders, that deduction is gone. Student loan deductions, they stay the same. Merit opportunity credits the same. Lifetime learning credit stays the same. Graduate student tuition waivers the same. That's still not income. So really not much change with respect to student tax provisions, education tax provisions. 529 savings plans, and Iowa allows 529 savings plans, most states do, now get to cover primary and secondary schools as well as college. So $10,000 maximum with respect to any particular beneficiary on that each year. Now a little bit more on 529 plans. This is really a big deal. So it's a district that allows distributions of up to $10,000 in expenses for tuition that's incurred during the tax year for enrollment or attendance at public, private, or religious elementary or secondary schools. That's a change right here. It's on a per student basis. Iowa does couple on that provision. So now that's expanded in Iowa too to pick up public, private, as well as religious elementary or secondary schools. So that's an expansion of the use of the 529s. There's changes with respect to the standard deduction concerning personal exemptions. The blue boxes here, dark blue is the old standard deduction, the light blue is the personal exemption. We can combine those two together. Now those are basically removed and we're replaced with now a new standard deduction, which is higher in each filing category than what we had prior. So that's what it looks like graphically. That kind of gives you the background graph behind why the zero filing amounts have gone up. Okay, so they changed the old standard deduction personal exemption structure to a new standard deduction, and the new standard deduction is higher than what the old ones were combined. Exemptions, old was $4,050 per person in a family. New, it's eliminated, well actually suspended because it's going to sunset after 2025. So that prior chart is just showing you graphically what this kind of looks like, or what that point looks like. Deduction versus credit. Remember the distinction between the two. Deduction is going to reduce your taxable income. Credit reduces the tax payable. It's a dollar for dollar offset. And then if you don't have enough tax to be offset by the credit, if it is refundable, then the government writes you a check. So you have then the refundable compared to the non-refundable credits. I wish they would have eliminated refundable credits. I don't like refundable credits. They're ripe for all types of fraud. We still have a lot of refundable credits that are in the code. Child tax credit, talking about refundable credits, used to be $1,000 per child. Now it's $2,000 per child. Okay, so I guess in one instance the law gives us an incentive to get divorced this year, but at the same time gives us an incentive to have more kids by the end of the year. Get that additional tax credit. $2,000 per child under 17 with $1,400 of that refundable. Meaning if you don't have the tax liability to use the credit, then to the extent you don't, they're going to write you a check. So if I only have a tax liability of $1,000, I still get the full $1,400. I'll get a $400 check in that instance. So they doubled the credit, made more of it refundable, and then added a non-child dependent tax credit of $500. So if you're, maybe your grandparents, you're taking care of grandparents, or children over 17 that are still living in your basement, if you have any of those floating around in your basement, and so forth. Now that one is not refundable. The child tax credit is refundable. The non-child dependent tax credit is not refundable. You have to have a Social Security number for the child to claim the child tax credit, but not so for the non-child dependent. Okay, problems with that? There's no fraud potential in that one at all. Okay. Now you can't claim the dependent tax credit for a taxpayer that uses you can't claim it for yourself. That would be nice, but you can't. I'm dependent upon myself. Now, after 2025, this all goes away, so we go back to a $1,000 child tax credit and no non-child dependent credit. So we unwind all of this after 2025. Okay, but that's where we're at right now. Income phase-outs also on the child tax credit are dramatically increased. You may have found that yourself, or if you have clients, were eligible, they had an eligible child that theoretically they could claim the credit, but then they got phased out by the income thresholds. And now the income thresholds have gone way up. See, it used to be 110,000 married filing joint, 75,000 single. Now it's 400,000 married filing joint before you're phased out. That's a big deal. I mean, really made some significant changes with respect to the child tax credit. A lot more people are going to be able to claim it. The reason that they increased it, they doubled it, made more of it refundable, and increased the phase-outs was to basically buy Marco Rubio's vote in the Senate. So this is what Rubio got, or Little Marco, whatever it's called. Okay? It's interesting. There are a number of those types of things that are in the bill, and you can tell they were buying a particular vote with respect to, they might want the main senator over here, or they needed Rubio, or they needed somebody else. And so you get these various provisions, and that historically is how has happened. Now the thresholds on this are not indexed for inflation. So they told Rubio, okay, we'll do this with no inflation adjuster, but the doubling and the enhancement to the phase-out was so dramatic that by the time this thing sunsets, you wouldn't probably have had an adjustment anyway. Okay. Miscellaneous itemized deductions. Just a few comments on this, then we'll get to the meat of the discussion here. State and local taxes, the old rule used to be you could deduct property, your state sales tax, your state income tax. Now you get a $10,000 limit for property or income sales tax. Now, one of the things I'll talk about later, I'll mention it here. Don't get confused on this because there has been some confusion on this. COTB means conduct of trade or business. If the taxes, these taxes are paid or accrued with respect to your trade or business, then there's no limit. There's no $10,000 limit. And so, you get questions with respect to property tax on my farmland. Am I limited to $10,000? No, that's your business asset. There's no limit on that. Okay, so don't be confused on that. Now, the way the statute reads, the $10,000 limit applies for both individuals as well as somebody married filing joint. It's not 5 and 10, or it's not 10 and 20, it's 10. I wonder if that's correct, or whether we'll see a technical amendment on that. But that's the way it reads right now. You would normally think that they would be different depending upon filing status, but no, it's just 10, period. Now, mortgage interest, you can deduct the mortgage interest on the first $1 million of home debt. That changes to $750,000 of home debt if your mortgage is taken out after December 15 of 2017. There's some grandfathering that's in there for contracts that were already being processed. Still applies to both the primary residence and a designated second home. So if we keep the max under 750, we're all right. Now this won't have much application in the middle part of the country. This does have application on the coast, California, the Northeast corridor, selected spots in the center part of the country, but not too much. Have any of the preparers here, have you ever encountered hitting the limit? You have? Okay. Well, not too many, I suppose. 1 or 2. Yeah. Okay. You might see it, but again, not too much here. It does apply, as I said, to a primary residence and a designated second home. Now, the point to watch here is that home equity indebtedness is no longer deductible. Now, acquisition indebtedness is, but be careful here. Sometimes lenders will classify certain debt as home equity debt when it's really acquisition debt. And you want to be careful about that because now the tax difference makes a big deal. So make sure things are properly classified from a tax standpoint. The lender may properly do it, but before it didn't matter how it was classified as much as it does matter now. So make sure that what is home equity debt really is home equity debt. How are those funds being used? And we want to make sure that it's properly classified because home acquisition debt is deductible, home equity debt is not. Okay, charitable provisions, well, changes here. Your max in any given year is up to 50% of your contribution base. Now that goes to 60% to the charities that are in 170B1A, which would be most of the charities that we would think about. The disallowed amount will carry forward for 5 years. Now there's a rule, there was a rule for the ability to deduct 80% of rights to buy tickets to athletic events at a higher education institution. That one's been repealed. And there is a strategy to get around that. I don't have time to get into that today. That's a donor-advised fund. You can also continue to make a donation direct from an IRA to a charity if you're over age 70.5. That's been a very popular provision. That stays in place. Iowa does couple on that rule where you can make the gift direct from your IRA to a charity if you're over age 70.5. So you can do that on the state return as well as the federal return. All right. Casualty and theft losses, not too much change here, but you only get to deduct the losses if they're attributable to a federally declared disaster. That's a change in the rule with respect to casualty and theft losses. Miscellaneous itemized deductions. A lot of these are suspended. In other words, removed through 2025. As we said, employee business expenses, tax prep fees, investment interest expense, personal casualty and theft losses, except for those federally declared disaster areas. And there's a whole list of these. I'm just picking out a few just to illustrate. Modified, as I said, charitable contributions increased to 60% of your contribution base. There's a change with respect to gambling losses. Watch the medical expense deductibility rule. For 17 and 18, this is one where they went back and said we're going to make the change effective for 2017. You remember the rule used to be before the health care law that the threshold for deducting medical expenses on your Schedule A, you had to get up above 7.5% of your AGI. Then it went to 10%. Now they're taking it back to 7.5% of your AGI before you can deduct your medical expenses. And so the threshold is 7.5% last year and this year, and then next year goes back to 10. Don't ask me why that moves around like that. I can't figure that one out. I don't know who was concerned about what on that one, but that's a weird one. That was in play now retroactively for 17, going forward to 18. Then we're going to go back to 10% of AGI once you get to 2019. Net disaster losses, if they're incurred in 16 or 17, they're deductible regardless of whether the aggregate net losses exceed 10% of AGI. But they have to exceed $500 per casualty. ABLE accounts these are special accounts that were created a few years ago for disabled individuals that meet that definition. They've made these more beneficial. The additional contributions after the per donee annual overall limit of $15,000 is reached, so there's a way to get more money into those accounts. It's limited to compensation of the individual for the year or the federal poverty line of a one-person household for the prior calendar year. And it's the greater of these two. Beneficiary of the account can claim the saver's credit for contributions they made to their account. And now, with respect to 529 plans, you can roll over an amount that's in a 529 plan to an ABLE account. So, kind of a unique provision that's out there. It's handy for disabled persons, and they've made it more accessible. Now, let's look at page 1. That's a brief intro of the overall law. If we go to page 1, commodity gifting. Let me go back to this. And as I said, under prior law, a Schedule F farmer that's doing commodity gifting and savings can be rather significant. It eliminates self-employment tax on the grain gifted because we don't have a sale that would trigger SE tax. We have a gift of the grain. And under the kitty tax rules, the tax rate of the child is usually equal to the parent's rate. Okay? So if the farmer's under the wage-based amount, which this year is $128,400, it looks like next year it's going to be about $132,300. they'll save about 15% due to making a gift to their child. Okay? But under the new law, as I said, changes the child's tax rates on unearned income to be equal to the tax rates for estates and trusts. So once that child hits 12.5 of unearned income, they're going to face a maximum rate of 37%. It doesn't matter what the parent's rate is because we're going to use the trust and estate rate, 37%, the top rate. So I think that's going to make it much more costly for farm families to give grain to their kids or their grandkids and receive any tax savings. Now, it'll still save SE, but what you now have to factor into the equation is that 37% rate on the child's unearned income once you hit 12.5. And that may change the math on that for any particular situation. Deduction for state and local taxes, again, as I said, there's that $10,000 limit, but does not apply to property tax related to farm business property. If we take a look at an example on this, right at the bottom of the first page, Bob and Sally own a home in Oblong, Illinois. There is actually a town in Illinois called Oblong. Anybody ever been there? A number of years ago, there was an announcement in the local paper over there and said that oblong man marries normal woman. You know, there's a normal Illinois. Right? Years down the road, they had birth announcements of their kids, and they turned out to be squares, but nevertheless. But Bob and Sally own a home in Oblong. The real estate tax on their home is $2,100. They also pay $87.50 of Illinois state income tax, so their total personal and real estate tax and state income tax is $10,850. The maximum deduction they can claim on Schedule A for those taxes is limited to 10, so that's where the limit would come in. That does not apply. The real estate taxes paid on farm real estate doesn't matter how it's owned, whether individually or through an entity. Next example on top page 2. Jerry and Lisa own a farm near Goofy Ridge, Illinois, which is also a town in Illinois. Part of the farmland is owned by an S corporation that they're the shareholders of. Part of the farmland is owned by an LLC that Jerry and Lisa own. Jerry and Lisa also own part of the farmland individually. The S corporation pays $15,000 real estate taxes. The LLC pays $8,000. Jerry and Lisa pay another $9,000. All of those are deductible. $10,000 limit does not apply in that situation. That's associated with farmland that's used in their trader business. So again, that's just illustrating COTB, conduct of trader business. If the taxes are associated with the conduct of a trader business, there is no $10,000 limit on state and local taxes. Any questions on that? Don't miss that one. I got a lot of concern from farmers living here about that, and that's not a problem.
So I just
We have
want,
questions? Oh, very few farmers in this audience. Okay.
so I just had
Just the
I
commentary.
had one question on that. With respect to, for individuals who have multiple businesses per se, where they've limited it to a passive situation for tax purposes, how does this apply? In
Yeah,
those
that's a
situations?
great question because well, let me say a couple things. That's a real good question, and we don't have any guidance on it. We don't have any guidance on any of this stuff yet. And we have no forms. We have very little in terms of announcements. What the thinking on that is, and my thought on that is right now, is since the language in the statute does require the taxes to relate to a trader business, that's going to impact rental type activities. So if I've got let me give a farm example. I've got farmland, but I'm not farming it and I passively lease it out on a cash rent basis. Well, that's not a farming activity anymore. That's a rental activity. So do I get a $10,000 limit on the property taxes that I'm still paying? I think the answer to that is likely to be yes. That may be the position that the Treasury takes on that.
That you would be capped at 10,000.
That you would be capped at 10 because now you're in a rental activity, you're not in a farming business. So for retirees, if that's the case, then we'd have to restructure rental agreements so that we wouldn't be capped at the 10. See what I'm saying? So we'd want to get into some type of share arrangement. The same thing might be true for non-farm rental activities. But again, I don't know exactly how the Treasury is going to interpret the provision because we have no guidance in the code as to what code sections we look to determine the test for trader business. And the reason that's important is because we have special carve-outs under certain sections of the code for farm activities compared to non-farm activities. It depends which way the Treasury wants to plug this through. We have no guidance in the statute as to which code section we're going to. So that's one of the things to watch, and that's a very good question, a very important question, because that will affect what we want to do in terms of our rental activities, depending on what Treasury tells us. Yes?
Business expense, what's underneath that? I know that meals are, but what about mileage in these cases and so on?
We can still claim mileage for business-related miles, according to the IRS prescribed rate. That doesn't change. A lot of what changes is at the employer level under TCJA. That's a good way to think about it. What the employer used to be able to provide as a fringe, those are gone. So an incentive under TCJA is to be an independent contractor now rather than an employee, because an independent contractor still gets all the write-offs that they normally had. Employees, not so much. It's the employer-employer type relationship where you lose a lot of the deductions that we used to have. So one of the things that we visit with practitioners about often now is, are there ways that you can restructure arrangements to independent contractor status to preserve the deductions for that individual? Because a lot of the employee deductions are now removed. That's a general way to think about that. And the meals and lodging one, I'll come to that a little bit later. That one's a carve out too. Does that answer your question? Yeah. So yeah, the new law does favor independent contractor relationships as opposed to employer-employee type relationships. All right. For non-corporate taxpayers, now again, in many of these apply across the board, and we have special carve-outs when we get to ag. But for non-corporate taxpayers and NOLs, we really want to try to avoid NOLs to a much greater extent now than in the past, because they're not as useful to us. There's a limitation. So for tax years beginning after December 31, 2017, for all businesses, farm, non-farm, doesn't matter, your limit is $500,000 on a married filing joint return on net operating losses. Now, we used to have in ag an excess farm loss rule that was created under the Farm Bill in 2008 of $300,000. That's gone. They took that off the table. Everybody is subject to $500,000 limit on net operating loss on a joint return. The excess that's disallowed, let's say you had $600,000, the rule is $500,000, so we've got $100,000 that's disallowed. You can carry that over, and that'll be treated as part of your NOL carry forward in subsequent years. And so then the next limitation kicks in. The NOL deduction is limited to the lesser of the carryover amount or 80% of taxable income. So here's your next haircut on NOL, 80%. Now, on the carrybacks, remember the rule used to be non-farm back to forward 20, and then farmers had the option to go back 5. No. Nobody can carry back an NOL anymore to offset income in a prior year, unless you're a farmer. Then you can go back 2, but if you're a non-farmer, you can't carry an NOL back. You can only go forward. Now, the 20-year carry forward is eliminated. It's indefinite carry forward. So the 20-year carry forward on NOLs is gone. That rule's gone. It's indefinite carry forward. But, and nobody can carry back except a farmer. And a farmer can go back 2 years to offset income from a prior year. But this raises a question as to what taxable income is for this purpose. And so we get into an example with respect to this. Go to page 3. Now this, I give you farm examples here, but they apply. This one applies in all contexts here in terms of what is the definition of taxable income. Bill is single, operates a farm in South Dakota. In 2018, his farming operation experienced a $700,000 loss from the farm, let's just say farming activity, and from the sale of farm equipment. He can carry back $250 of the loss to 2016. Why $250? He's single, so that's his limit. Whether he's a farmer or not, you're going to be limited to $250. So he carries back $250 of the loss. Now, if he were not a farmer, there's no carryback. But since he's a farmer, he can carry back 2 years. The remaining $500,000 of the loss carries forward to 2019, and if in 19 he has $450,000 of income from his farming activity, he can offset that with $400,000 of the carry forward. So that's 80% of the amount carried forward. So that gets you 400,000. So he'll have 50,000 income subject to tax in 2019 with the remaining 100,000 of loss carried over. So the carry forward rule is going to be the same whether it's farm or non-farm. Here he was able to go back only because he's a farmer. But then you see the 80% of the amount carried forward, that rule limited. That rule kicking in. Does everybody understand that one? That's quite a different way to treat net operating losses than what we've been used to in the past. Okay? We really want to try to avoid NOLs to a much greater extent than we had in the past. All right, loss strategies, we don't want them. Possibly, there are other techniques to try to minimize the impact of NOLs. All right, business interest. Some changes with respect to the deductibility of business interest. You might run up against a 30% limitation. Okay, so when we talk about, I have cash accounting next, and then business interest on page 4. I'm going to discuss these kind of together because they do fit together. Now, I've laid it out in the materials as cash accounting first and then business interest. But let's talk about business interest. There's a possibility that you're going to have a deduction or a limitation on the deductibility of business interest. It might be limited to your business income, farm, non-farm, doesn't matter, plus 30% of AGI. And you can see how that's computed, and there's going to be a change in the way that AGI is computed starting in 2022. With the excess being carried forward. However, if you can use cash accounting, which I talk about on bottom of 3, spilling over on top page 4, which is limited to those businesses that are at or under 25 million of average gross receipts. So if you keep your average gross receipts from your business at 25 million or under, it is gross receipts, you can use cash accounting. That's a change in what the rules used to be. We used to have different limitations depending on types of businesses and so forth. So now they've lumped everybody together, put a ceiling of 25 million on average gross receipts. If you keep it under that threshold, you can use cash accounting. If you can use cash accounting, then you're not subject to the limitation on business interest deductibility. That's how the two fit together. Doesn't matter farm or non-farm. Although now there is a special carve out for farms. Once you get above 25 million of average gross receipts, then you hit the 30% limitation on deductibility of business interest, unless you're a farmer and you elect out of that. So, again, another special carve out. That one was created, I got a call, I was involved in various aspects of this legislation. I got a call from the livestock industry early on in this process. They were worried about what they were seeing coming. And this was in November, December, and they said, are you familiar with how the livestock industry functions? And I said, well, I know you guys are highly leveraged. I said, yeah, we pay a lot of interest in our business. These are the big feedlots. I mean, the ones out in southwest Kansas and Oklahoma and down in Texas. I don't think Iowa has any that are near the size of what I'm talking about. We might have a couple that would hit the 25 million amount. But so we're highly leveraged, we pay a lot of interest. This is going to hit us if we can't use cash accounting, then we're going to get limitations on deductibility of interest that really affects our business model and our profitability. So what we came up with, we put our heads together on this, kind of went back 30 years to what happened with respect to the opt-out that was given to farmers under the uniform capitalization rules where they didn't have to capitalize the cost of raising livestock. Plants, yes, livestock, no. And so farm businesses were given an ability to elect out of the application of this rule and be able to fully deduct interest. And if they do so, they're going to be limited, their depreciation is going to slow down on their farm property that has a recovery period of 10 years or more. They're going to have to use ADS and will not be able to use bonus depreciation. So that's the price they had to pay to get the ability to opt out. Non-farm businesses, no. Once you hit the 25 million threshold, you can't use cash accounting. And that's going to make a difference tax-wise to you. Normally, you're going to want to stay under that threshold. Now, Iowa does couple on the accounting method changes. So that 25 million, Iowa couples on that. So that's good. Anytime we have coupling, that makes life a little bit easier in most instances. So questions on the interest deductibility? When you hit the 30% limitation is when you can't use cash accounting. The cash accounting threshold is 25 million average gross receipts. The only exception to that is if you're a farmer, you can elect out, but then there's a price you pay on the depreciation side of things. Okay? So there are some strategies here that we can suggest for getting around the business interest limitation. I would say talk to your tax professional on that one to see if this is a concern to you. What can you do to get around that? All right, fringes. As I mentioned a moment ago, one of the fringes that's gone, and this is bottom of page 4, top page 5, the business provided meals. And this is everybody. This is farm, non-farm. Employer provided meals are now deductible at 50% rather than 100%. These are the meals that are provided to the employee for the convenience of the employer on the business premises for the convenience of the employee, or excuse me, employer, as I said. You used to get the 100% deduction on those. Those are now only 50% deductible. Okay? Through 2025. And then after 2025, it doesn't sunset and go back to what prior law was. This one says it goes to 0. So we get the 100% goes to 50% on employer-provided meals, then it goes to 0 after 2025. That's a big deal. That is a very big deal. That's a big deal too. It's in the ag community too. Okay. And unfortunately, that is done after a major tax court decision was won by a taxpayer last year that allowed the 100% deductibility when the employer was merely leasing the meal facility, which is the exact correct result. But the IRS had been pushing on that and pushing on that, said no, the corporation has to own the facility in which the meals are provided. No, you don't. The question is whether they're provided on the business premises, and they were in that case. And that was a case that involved the Boston Bruins NHL hockey franchise. But now the court has given that, or the Congress has given that back. So no deduction after 2025. Any questions on that? Yes?
That doesn't include business meals for people who are traveling.
No, this is meals provided for the convenience of the employer on the business premises. Yeah, that's what this provision is. Depreciation changes. Now, this one's farm specific, and we have a couple of different rules here. 5-year for new farm equipment, 7 years for used. And your depreciation method changes from 150% declining balance on the 15 to 20 year, or excuse me, the 200% declining balance method applies, repeals the use of the 150% method for property used in farm business that's 3, 5, 7, or 10-year property. So the bulk of your farm equipment is going to fit into your single-purpose ag structures. But that 150%, the slower amount of depreciation still applies to your land improvements and your farm buildings, 15 or 20-year property. But so this is farm specific. All right. Now, plants. Do any of you have vineyards or other types of plants? Maybe a nursery, greenhouse. So, you know, they are kind of related to ag, but they're a little different. And sometimes we'll see these in Iowa. They've changed some of the rules with respect to depreciation concerning plants. And this gets into capitalization issues. I've got a whole page in the materials with respect to that. We have some questions as to what some of these provisions mean and how it works. So if you operate a greenhouse or you have a vineyard, you want to look at pages 5 as well as 6. And on page 6, I have an example of an individual that planted an orchard. May not have a great deal of application to this group today, but I'll just point that out to you that it is in the material. Okay, so we'll skip that. Depreciation. Now, for farm and non-farm, section 179, expense method depreciation is a big deal. And this is, when we get to this one, where I'm at is toward the bottom of page 6, under the header, subheading, expense method depreciation. Section 179, the maximum amount now is $1 million. So 179 goes up, phase-out threshold is $2.5 million, with indexing after 2018 for both of those amounts. So what that means is if you buy property that qualifies for section 179 and you place it in service, If the amount of that purchased and placed in service exceeds $2.5 million, for every dollar over $2.5 million, you lose $1 of the $1 million of 179 that you can claim. Okay? Very important for all types of businesses. Now also included as eligible for 179 are roofs and HVAC systems. So that's a big one for certain types of businesses too. Roofs and HVAC systems now count to be expensed under Section 179. And as I'll mention in a moment, you can use the 179 amount to optimize your taxable income if you elect out of bonus depreciation, farm or non-farm, doesn't matter. And I'll give you an example of how that's done in just a moment. Now, does Iowa couple on this? No. On the Iowa return, the 179 amount is set at $70,000 for this year, not $1 million. You only get $70,000 here, but the phase out beginning at $280,000. Okay. I had a sit-down meeting with Governor Branstad 2 springs ago, spring of 16, and I had produced a white paper on this issue because Iowa was balking. At that time, the governor was saying, well, there's going to be no coupling on 179 at all, period, for 2015. They were trying to figure out what the law was for 2015 and 2016 at that time. They were saying, no coupling for any businesses. And I produced a white paper on that, put it on my website, and was kind of, put it mildly, critical of that thinking. Because what happened, and the governor's statement at that time was, well, we can't do it because of the revenue hit that the state will take. What's the flaw in that logic? What do you do with an asset on which you've claimed expense method depreciation? What happens to your income tax basis? You drop your basis by the amount of the 179 that's claimed. Hence, in the next year, how much depreciation can you claim? Much less depreciation. So over the life of the asset, what difference does it make from a revenue standpoint to the state? It doesn't. It's a wash. It's the same thing. I was trying to get him to understand that. And we had a personal meeting. That white paper got me a personal meeting with the governor. And, I was in the office one day, and the secretary said, the governor's on the phone, I'd like to talk to you. Not the governor's staffer, the governor. Oh, okay. So I read your paper. Can you come talk to me about this? And he was very polite about it. He was not upset. And he said, this is a very good paper. And frankly, he said, I had not considered it in this manner before. And if you remember what happened in 16, it was about 2 weeks later that he made an announcement that, okay, we're going to do this for 1 more year. Remember that? There's no promise for 17. We're going to go ahead and allow a certain level of 179. It wasn't the full amount, but a certain amount for 2016. But then they didn't follow through in 17 as they indicated. And the legislature still has not done that. It's not a budget issue. Because if you don't claim 179, what are you going to do? You're going to claim much depreciation. If you claim 179, then you're not going to have that depreciation you claim in the subsequent years. So over the life of the asset, it doesn't matter. And that was my major point with respect to the paper. And we would want coupling, and I put a bunch of data in there showing the types of businesses that are impacted by non-coupling and so forth, ag and non-ag. But the other complicating factor here is I asked the governor, I said, do you prepare returns? Well, no, I'm governor. I said, right, you don't have time to prepare returns. The lack of coupling makes it more difficult to handle the different depreciation schedules for an individual and a practitioner. And if you mirror what the feds are doing here, it makes it much easier. So a lot of those types of comments fall on deaf ears, but nevertheless, the point was made. And I think he decided that, well, I probably should go to China. Leave this to somebody else. Okay. 100% expensing we have now. This is bonus depreciation. It's called bonus, but it's 100% expensing. So for assets acquired and placed in service after 9/27 of 17 and before 2023, you look at bonus, right? I'm on page 7 now. You can write off your qualified asset purchases immediately, 100% write-off. So this counts for new and used property. The original use doesn't have to commence with the taxpayer. So you just write off the purchases of your business assets, farm, non-farm, okay? Now, after 2022, you get a 20 percentage point reduction in the amount that you can write off. So it's going to go to 80, and then 60, 40, 20, and then 0. If the law doesn't change before we get here, which is entirely possible. So for the first tax year also, one other thing. First tax year that ends after 9/27/17, you can elect 50% instead of 100%. You may want to do that depending on your tax strategy. Same rules apply to plants that bear fruits and nuts. But note this next point. How much of this can you get in Iowa? On the Iowa return, nothing. Bonus is not allowed at the state level. Okay. So limited coupling on 179, no coupling on bonus. So that, again, is going to create a discrepancy between the federal and the state return. Let me show you an example with a farmer. You can substitute in whatever type of business that you have. Salmon Souffle, a married couple. Nobody got the, there you go, okay. You are alive, all right. That's my son provides me with a lot of these names, most of which I don't dare use, but I thought I could use this one. Salmon Souffle, a married couple conduct a Schedule F farming operation before depreciation of Schedule F income is $300,000. Their plan is to report Schedule F income of $77,400. So let's say you have a C business, and you want a particular level of taxable income on your Schedule C as part of your tax plan. Here this is an F, and they know where they want to end up, because what are they trying to do? They're trying to fill up a particular tax bracket. So that's what they're doing here. They want to completely fill up the 12% bracket, so they said, well, let's get to 77.4. What can we do with our asset purchases and depreciation that we claim during the year to get us there? They're trying to optimize their tax plan. So during 2018, they purchased $400,000 of new farm equipment. This might be a $400,000 piece of machinery that you're going to use in your business, whatever the case might be. You can write the whole thing off now. So 100% bonus on that would result in a $100,000 farm loss for 2018. Now, we wouldn't want to do that unless we were a farmer, because we got the ability as a farmer to carry it back 2 years. Now, we go indefinitely forward, but if we're not a farmer, remember, you cannot carry that back. All right? So we may not want to create the loss if we're not a farming business. So Sam and Sue could elect out of bonus depreciation on the equipment, and they could do this if we're even not talking farm businesses, and then claim 179 depreciation in the amount of $300,000. So they can pick and choose if they go out of bonus. Remember, bonus, the way it's wired is for eligible property that you can claim bonus on, the election is there, and you take bonus and you have to elect out of it. It's just kind of backwards the way we think about it. You don't make the election into it, it applies unless you elect out. So they elect out. Now they want to optimize the amount of depreciation they claim by claiming a certain amount of 179. And you can pick and choose how much 179 you want to claim. So they elect out and they claim 179 depreciation in the amount of $300,000 to bring their Schedule F income down to $100,000. Then they're going to take 22.6 of regular depreciation and get them right at 77.4. That's what I meant by the comment earlier on the screen, where an election out of bonus then allows you to use 179 to optimize your income. This is how you do it. Now, just change the facts from a farm set of facts to a business, a commercial business. You do the same thing here, except the only difference, remember, is on the loss side. You're not going to be able to claim that $100,000 and carry it back, because there are no carrybacks unless you are a farmer. Okay. So that gets them to 77.4, and then they're going to depreciate the remaining cost of the 77.4 over the life of that asset. Here would be a 5-year asset. Questions on that one? So think about that as for your businesses, the amount and the timing of your asset purchases, and whether you want to utilize the bonus depreciation or whether you want to elect out of it and try to optimize income by filling up the new tax brackets by utilizing a carved up 179 election. This involves several concepts right here that maybe your tax planner will sit down and visit with you about. That's really the power of what you can do with the new rules that are out there on depreciation. Now, one other thing, if you do have farm assets, since we've got two different rules for new or used property, with 5-year depreciation on new equipment, 7-year depreciation on used equipment, you can make separate bonus elections. Now, this only applies to farm property, but that would give you separate bonus elections. Now, the bigger issue, however, is that a state may not couple on bonus. Iowa does not couple on bonus, so that really doesn't matter on the state return. But they might couple on 1031 provision, which I haven't talked about yet, the like-kind exchange provision, not being available for equipment. I'll get into that in just a moment. Okay. So this is just an example, a farm example. A farmer buys 500,000 of used equipment, 350 of tiling, buys land with a machine shed worth 500,000. The old law would limit the deduction to 175 on the new tiling under 50% bonus, which is what it was last year. Under the new law, you get 1,350,000. You just take everything, or you elect out of that on an asset-by-asset basis. All right, and this is just showing the numbers, new law, old law. All right, so where are we on farm property? That's just a summary of where we're at. Another one, I don't have this in your materials, but since we're talking depreciation, let me just mention this one here. Qualified improvement property is a big issue for certain types of businesses, not so much for farming, but other types of businesses. This is qualified leasehold improvement property, qualified retail improvement property, qualified restaurant property. Those are the three categories of QIP, or KIP, that's what it's called. Historically, those categories have been 15-year property, eligible for Section 179. Now watch the problem that the TCJA creates, I think inadvertently. If property didn't meet the definition of any three of those categories, then it has, by definition, a class life of 39 years, which means bonus is gone, because to be a qualified asset eligible for bonus, you have to have a class life of 20 years or less. So you would default out of this if you don't meet the definition. Qualified improvement property, therefore, was generally eligible for bonus depreciation because it would meet the definition and would not have a class life of 39 years. So we could bonus qualified improvement property. The leasehold improvement property, the retail improvement property, and the restaurant property would be eligible for bonus, which is a really big deal now because it's 100%. Okay? Now, the new rules for assets placed in service after 17 is that the 15-year recovery period applies regardless of when the improvements were placed in service. That's what the new code provision says. Improvements that are qualified improvement property but don't meet any of the three definitions above default, as I said, to the 39-year recovery period regardless of when they were placed in service. Now, improvements that are qualified improvement property are eligible for bonus regardless of when they're placed in service. So qualified leasehold improvement property, restaurant improvement property will always be bonus eligible. Real property is bonus eligible when it's an interior improvement after the building was first placed in service. Normally, that's the way we would think of this. But they botched the drafting of the statute. Okay? Whether improvements are eligible for 50% bonus last year or 100% bonus depends on when they're both acquired and placed in service. If after 9/27/17 you've got 100%, so to be considered acquired after 9/27/17, cannot have a written binding contract in place. We would think that KIP that's acquired before 9/28/17 and put in service before that date should still qualify for 50% bonus under the old rules. But here's the problem as we go forward on this type of property, and there are lots of businesses that claim depreciation on this type of property. Those categories no longer do they exist. Leasehold improvement property, restaurant improvement property, qualified real property is gone. And there's no provision in the code identifying specifically QIP as 15-year property. Therefore, and it's not in the list of property that's defined as 15-year property in that particular code section under Section 168. You can't find it anywhere. It's not there. So by the way they wired this, they've inadvertently, I think it's inadvertently, removed this type of property from the definition of qualified property for bonus depreciation. Therefore, the way the rules work, it now becomes 39-year property and you can't bonus it. You realize how big of a deal that is for commercial development companies, other businesses that have leasehold improvement property, qualified real property, restaurant improvement property. you can't claim bonus depreciation on that when you were used to, and used to do it heavily in the past. Now, it still remains eligible for 179, but remember there's a limit on that. There's $1 million limit on that. And a lot of these types of businesses will blow past that limit and blow past the $2.5 million threshold where we start reducing the $1 million expense method depreciation. This is really a problem that's in there. So it doesn't have any defined cost recovery period. By just simply a read of the statute, that kicks it to 39 and it's out in terms of bonus. Does it make sense? No, it does not make sense. I'm part of a group with the AICPA group, and we've had numerous meetings with people on Capitol Hill, and I think there's kind of a tacit admission that we fumbled this one as the drafters. And technical correction, yeah, it needs a technical correction. Until then, for the practitioners that are dealing with clients that have this problem, I would say you suggest to them, look, the only argument that we have for claiming that this type of property is eligible for bonus is legislative intent based on a statement that's in the conference report. Because clearly the conference report, which is kind of the summary of what they were thinking, the conference report indicates that it's still eligible for bonus. The statute says you can't get there by reading the statute. Now, if we end up in litigation on this, we don't get guidance from the Treasury on this, what's going to control? Statutory language or the conference report? Statute. So this is, drafting matters, and they have to be very careful on these types of things. And this one, they dropped. And so this is a big deal, again, for certain types of clients that have commercial properties, and you have these types of qualified property. Okay, questions on that? And it's the problem with the inability to claim bonus depreciation, which is a big deal now since it's 100% for a few years. All right. And believe me, the real estate industry realizes that problem that's out there, and the developers. Like-kind exchanges, trades. Can you still trade property tax-free? The answer is, it depends. That's always a good response with respect to tax questions. Yeah, I'm still grading law school exams. I taught farm income tax for the law students this spring. And when I was writing the final, I really got in the mood of writing questions. I ended up with 100 questions. That's a nice round number. We'll give them 100 questions to answer. For some reason, I wasn't thinking at the time, I'm going to have to grade this. So that was 6 weeks ago. I'm still kind of cranking through the grading on this. I created a major headache for myself. I'm not going to do that again. I gave them 100 questions in 6 days to do it. Open book, open notes. You can look at the regs, you can look at the code. I didn't care. I mean, I got to figure it out anyway. Go ahead. Now I got to read all this stuff. Yeah, not too good. But they're trying to wind their way through all the changes and so forth. And I'm wondering how many times, because I kept telling them during the semester, a good response to a client when they bring a tax question to you is, well, it depends. Because 90% of the time it will depend, won't it? So that'll buy you some time to figure out what the answer is. I'm saying that tongue-in-cheek to them. So I'm starting to see that on these exams. That I go, well, it depends. I give them a factual situation. It depends. Well, that's going to get you partial credit. Now I need to see what it depends on. But on like-kind exchanges, can you still do them tax-free? And the answer is it depends. Personal property trades? No. Real property trades? Yes. So they continue to allow, going forward, trades completed after 17, real property trades. And remember, real property is broadly defined. You can trade bare farm ground for a commercial property in town that you're going to hold for investment purposes or for production of income. The holding reason that you're holding it is what matters. Or you can trade bare farm ground for bare farm ground. So real estate's real estate. Personal property, we had to trade within like kind of class. But we can't get a tax-free exchange on personal property trades anymore. Okay, and this is a permanent provision. So this is one of the things that will not sunset. There has been an attempt to change the 1031 exchange rules for a number of years. Iowa does not couple on this, which is interesting to me. I thought if there's one thing they will couple on, it's this. No, which means you can still trade personal property for Iowa tax purposes, tax-free. To me, that's just backwards. what I would have expected the legislature to do. I told my wife when I saw that, I said, they really are drinking something down there. Normally I would, no, we won't couple on that. Okay, we will couple on this. Okay. And these new rules, barring non-real estate trades, apply to exchanges completed after 2017. Now, for farmers, does this mean farmers will stop trading things? No, of course not. Many of you here have farm clients. I think there are a couple things you have to understand about farmers, and that is they're born with 2 or 3 genetic chips in their brain, and it comes at birth. One of those is, we're going to trade. We're going to trade combines and tractors, and we're going to trade them every year, every other year. We're just going to do that. Whether it makes tax sense or not, we just trade. That's what we do. I started doing this on the playground in elementary school with marbles. I started trading things. Okay? The other genetic chip that a farmer is born with is never pay self-employment tax. Do whatever it takes. Don't pay any self-employment tax. You guys that prepare returns know this. It may not make sense, but okay, we don't pay self-employment tax. So those are the 2 genetic chips that I think a farmer is born with. Will farmers stop trading tractors? No. But it just becomes taxable now. Trading value is going to be listed as the selling price on the Form 4797. So your trade value is your selling price. So I'm not just talking tractors here, this is what I have on the screen, but anytime you're trading personal property other than real estate, your trade value becomes the selling price, which means you're going to have gains since now it's a sale. So maybe I'm not a farmer, I'm trading some personal property in my type of business. I'm trading machines for whatever the case might be, like kind, like class. It's not tax-free. Your trade value is the selling price, which means now the entire asset value gets added to the depreciation schedule and you expense the whole thing off. So in one respect, we could say, does it matter that we can't trade personal property? Well, no. Why? Because we can add the value, add that basis to the depreciation schedule and write it off. Oh, okay. Now, whether that's a good tax strategy or not, depends. The other question that comes up, and I'm going to get into this qualified business income deduction, is whether the gain reported on the 4797 now is eligible for a sole proprietor or a pass-through business for that potential 20% deduction as a qualified business income deduction. And that's a trickier question because 4797 gain is gain from the sale of a capital asset, and capital gain income is not eligible for the 20% deduction. It's not in your computation of that. So the answer is going to be, well, initially, when you do your computation, it is, but then you kick it out because you have to back out income tax as capital gain, even though it's from a 1231 asset, is included in the definition of capital gain that's not eligible for the deduction. So the answer is no, it's not going to be. So you get depreciation on it, but you can't claim it as part of your computation for determining your QBI deduction. Now, more on that in just a moment. But personal property trade's gone, except in Iowa, because there's no coupling on that. You know, for those of you who do not prepare returns in Iowa, count your blessings. Just think of the different depreciation schedules, federal and state, that now you have to play with. Okay. So let's get past that. And this just shows you old, new, and I'm using a piece of ag equipment here, but you can substitute in, a piece of personal property, whatever business you're talking about. The tax result's going to be the same. Let's say we've got an asset, non-real estate, worth $200,000. I'm trading it on a new asset worth $500,000. So the old law would mean, hey, we don't have any gain. This is a 1031 exchange. There's no gain. The $300,000 cost basis is eligible for 179 or bonus. Under the new law, since it's not a 1031 eligible transaction, I've got $200,000 of gain, and I've got a $500,000 asset that can be fully deducted under bonus depreciation. All right, now at the state level, let's say I've got an old asset worth $200,000, I traded it on a new one worth $500,000 under the old law, no gain, that's 1031, tax-free exchange, and $300,000 in cost basis is depreciated over the life of that asset. Under the new law, it doesn't qualify for 1031. I got a $200,000 gain, $500,000 depreciated over the life of the asset, which means I have a larger tax hit in the year of sale. Okay, that's how that works. Corporate tax rate. How many of you, yes, question?
You said before that you could do an exchange for, of land for a commercial facility. Can, if you're a farm operation, could you do an exchange of, say, a livestock facility for land?
You can, however, you may have what's called 1245 component in there, and that'll create some depreciation issues for you, some tax issues. So you got bare land, and then you got a facility on it that you're trading for. Yes, it's real estate to real estate, you can still do that, but then you're gonna have to account for what's known as the Section 1245 assets. So then you're gonna have a component of that that's taxable, even though it's a real estate trade. Yeah, that's a good question. Okay. Now, how many of you have either asked your tax practitioner or the practitioners here, how many of you have had at least one client ask you, is my business structured properly now based on the new law? Do I need to change the structure? Yeah, one person who's honest. Okay? This is a very common question. Should I be a C Corp? Should I be a sole proprietor, an LLC? Given the change in the rules, what are we talking about? What's driving this? Well, the corporate tax rate goes to a flat 21%. This is the old rate schedule. The new rate schedule is easy, it's 21%. You see a potential issue in there? What's the potential issue? What's one of those rates? 15. Now, if you remember your grade school math, that's less than 21. So based on your income level, take a look at this. If you're here, it's 15% and it's going to go up to 25. So basically, anything until you get about in the mid-70s, you're under 21. Then it starts to get higher. So again, the answer on structure, just based on the tax rates, is what? It depends, yeah, you're catching on. Okay. It depends. Okay. Well, let's dig a little bit deeper on that. So here we can see the flat 21% rate is effective for tax years beginning after December 31, 2017. 20% corporate AMT is repealed, so the AMT at the corporate level is repealed. Okay. It's a blended tax rates also for corporations that have fiscal years beginning before 17. This might be a question to you. How many of you have C corporations for your businesses? Okay, of those, how many of you are on a fiscal year? Okay. What's your tax rate going to be for this first fiscal year ending in 2018? Is it going to be 21%? Now, actually, the way you answer this is you could be right either way, because it's a blended tax rate. What? You see, part of your tax year includes 2017, which was the prior rate structure. Part of your tax year includes 2018, which is the flat 21% rate. When Congress does monkey business like that, there is a code section that comes into play, section 15 of the Internal Revenue Code, and yeah, this is it right here. Let's say that we have, now this is farm, but you can ignore that. You've got a partnership that has 4 equal C corporations. The partnership income for the fiscal year is $200,000 for the tax year. Under the old law, the corporations each paid $7,500 or $30,000 of taxes. Under the new law, they each paid $10,500 or $42,000. That's a 40% tax increase. And this particularly will hit farm corporations because what we've historically done with farm corporations is deliberately keep taxable income at $50,000. So this is an automatic 40% tax increase. It's now 21% instead of 15%. That's a 40% increase. That's one thing if you have a farm corporation you better watch real closely, just because the attempt has been to limit that taxable income to $50,000. Now, let's say we have a corporation, again I'm using farm corporation, but it doesn't matter, farm or non-farm, point's the same. As a March 31, 2018 year end, or any fiscal year end that's after January 1 of 18. So we've got some of the tax year in 18, some of the tax year in 17. Let's say total taxable income is $50,000. How do you determine your tax? Section 15 of the code is going to say we take the number of days in 17 out of your total fiscal year, so let's say this 365, or let's just round it off from, we have a March 31 year end, we've got 3 months in 18, 9 months, or 75% in 17. So we take the pre-18 tax under the pre-18 corporate tax rate system of $7,500 times, or 7,500 times 3/4, we round that off, our tax liability would be $5,650. So we look it up in the table, determine it's going to be 7,500 attributable to 17, and we take that times 3/4, we get a bottom dollar tax liability based on the 17 days, 2017 days of $5,650. Do the same thing for 18, and that's $2,590. Our total tax is going to be blended and $8,240. So you get a blended rate. That's the whole point. So that answers your question with respect to how do I compute my tax liability for this first fiscal year. All right. Now, some more on the Iowa stuff here. This is where it really gets messy. For tax years beginning in 19 only, Iowa couples with federal law as of March 24, 2018. Now remember, there was another amendment to TCJA that came in on March 23rd. There's a so-called grain glitch with respect to the QPI deduction. So now the legislation said, okay, what the federal law is as of March 24, here's what the rules will be for 19 only. For tax years that begin in 19. Section 179 will be 100,000 with a phase out at 400,000. What is it for this year? 70. Next year it goes to 100. Phase out at 400,000. No bonus. I haven't talked about the QBI deduction yet. I'm coming to it. But at the state level, you take 25% of that 20% QBI deduction at the federal level. 25% of 20. Okay. Not sure if that includes a co-op amount that's passed through to the individual patron of the co-op. I think so, but the legislation's not clear. No personal property exchanges for tax years beginning in 2019. You can do it in 18, then they're going to take it away. But you can elect, they take it away, but then put in an election to allow it. So in 2019, you have to elect to get it. You don't have to elect to get it in 2018. Very slight reduction in rates in 2019. I mean, we're talking fractions of a percent. I mean, it's just minuscule in 2019. No $10,000 limit on deduction for state and local taxes on the state return for tax years beginning in 19. No change in the Iowa corporate tax rate. Iowa will still have the highest stated corporate tax rate in the country. Iowa stays number one. You might have seen those ads on TV. You know, we're number one. Yeah, and the corporate tax rate is highest in the stated rate. Now, Iowa's got a bunch of credits and deductions and carve-outs. If you're favored by the legislature, then you can reduce your corporate tax rate. All right. But the stated rate is still the highest at 12%. 5-year NOL carryback for farm losses. This is in 19. More stuff subject to sales tax. Note here, online sellers. They're jumping the gun on the cases before the U.S. Supreme Court right now. I told a couple of committees earlier this year, you better wait on that because you may not get the result that you're hoping for out of the U.S. Supreme Court. That's a case coming from South Dakota, where South Dakota deliberately enacted unconstitutional legislation about 3 or 4 years ago, where they were going to tax online sellers that had no physical presence in the state. Well, according to U.S. Supreme Court precedent going back 50 years, you can't tax somebody that doesn't have a physical presence in the state. Of course, that opinion in 68 and the subsequent opinion in 92 were pre-internet. And so the argument is, well, this is different now. I'm not sure it is because the constitutional principle is still the same. You tax somebody that doesn't have a physical presence in the state and can't vote you out, then that's taxation without representation. And that's what the U.S. Supreme Court is struggling with right now. So we'll see what they say. They're going to have to break 50 years of precedent to change their mind on this. But Iowa went ahead and said, oh, we're going to tax online sellers regardless of the physical presence. That may change. So just watch. We should have an opinion out by the end of June from the U.S. Supreme Court case. Now, for tax years beginning on or after January 1 of 20, they have what's called rolling conformity with federal tax law with exceptions. Great. Section 179 is conformed to federal law. No bonus, no like-kind exchange on personal property trades, lower individual tax rates and fewer brackets if they meet revenue targets. And if they don't, you don't get it. And if the targets are met, then there's no federal deductibility on the state return. But this doesn't start until 2020. And then in 2023, they changed the Iowa capital gain provision. Only farmers are going to be able to take it. The Iowa capital gain provision will apply only to net capital gain from the sale of real property used in a farming business that is sold to lineal descendants. But only when revenue targets are satisfied and the lower rates are triggered. I don't know who thinks up this stuff or who has time to think up all these permutations to this stuff. Anybody want to guess that a lot of this changes before we actually get to these dates? Your guess is as good as mine. I don't know. But that's where you're at. More Iowa stuff. Stuff is the technical tax term. When I have no other idea what to call it, it's called stuff. In 2021, you can claim half of the federal QBI deduction. In 2022, it goes to 75%. Then it goes to 100% if they meet their revenue targets. The Iowa corporate tax, starting in 2021, is reduced from 12% to 9.8% for income over 250. Corporate AMT is eliminated starting in 2021. No federal deductibility for corporations. Starting in 19, the geothermal tax credit is gone along with the geothermal heat pump tax credit, and they did not increase any funding for the beginning farmer tax credit. Okay. Enough on Iowa? Any questions on that? That's the definition of a convoluted mess, as far as I see it. That's going to be tough. The burden now is on the Department of Revenue to produce the rules to figure out all this stuff. I wouldn't want to work for the Department of Revenue right now. And one of the problems they have is they lost their best guy, in my opinion, about 2 years ago to retirement. And he's out fishing and he doesn't answer his phone. Good for him. But they're kind of at a loss without him. You know what I'm talking about. Yeah, he was absolutely superb. And they really struggled without it. This is going to be really tough for the Department of Revenue. Okay, 199. Let's spend the balance of our time on 199. And this is on page 8. And we'll work through a lot of examples here. This we could spend all day on. This is the new QBI deduction for pass-through businesses and sole proprietors. I want to make it's really difficult stuff, and I've taken a lot of time to try to write this in a way that it flows logically. Here's how you do this, here's how you think about it. This is about the 16th revision to stuff I started working on in December, and started teaching it to students. Then I would go back and, no, that's not the best way to convey this. So I'd rewrite it, and so forth and so forth. So I think we've got most of the bugs worked out. I did discover an error I have in one of my examples. It's pretty obvious in the math. The math is wrong. But taxpayers other than C Corps are taxed using the individual rate structure. So this goes to the question, well, what form should my business be? Should my business be a C Corp and get the lower rate? Should my business be a non-C Corp and get the 20% deduction? Okay, what does it matter? Now, taxpayers previously were allowed a domestic production activities deduction. If you're in a business and you make something, manufacture, produce, grow, or extract, if you do any of those activities domestically in the United States, you can get a 9% deduction for qualified production activities income, which was limited to 50% of your wages expense. So whatever your wage expense was, your deduction could not exceed half of that. Okay? Cooperatives, ag co-ops could take the DPAD too, and they could pass some, all, or none of it through to their patrons. That was removed. So they eliminated the DPAD and replaced it with a 20% QBI deduction. It's kind of modeled after the DPAD. But it's only there through 2025. The basic idea is to allow a non-corporate taxpayer to take a 20% deduction against income from their business. So this is who it applies to. Modified rule applies to a specified service, trade, or business. So normally, under the old rule, a service business such as a CPA firm, an accounting firm, a law firm could not get the DPAD. Now they can claim the new QBI deduction under certain rules. If their income for the business is below a certain level, then there's a different way that we compute it compared to non-service businesses, such as manufacturing, agriculture, whatever the case might be. Okay. So the DPAD was repealed. However, interestingly, that 9% DPAD that was good at the federal level through last year was not repealed for Iowa purposes. Now that, to me, that is a real head scratcher. How in the world is that going to work when you can claim an old DPAD and 25% of a new QBI deduction? I don't know how the Department of Revenue is going to figure that one out. That's going to take some mechanics to wire that one through. That's where we're at right now in Iowa. And they put in a transition rule for patrons of co-ops. So it's for taxpayers other than C corporations. I want to emphasize that. C corporations cannot claim this one. Applying for tax years beginning after 17 before 2026. Separate trades or businesses, you're going to compute your deduction for each of your separate trades and businesses, and there might be a wage or investment limitation that can apply to each business. Now that's based upon threshold income plus a phase-out rate, so it might or it might not apply. It only applies for income tax purposes, not self-employment tax, not the passive tax under 1411, the NIIT. It's determined without regard to A&T adjustments, which means it's allowed against alternative minimum tax, which remember still applies for non-C corporations. It's allowed to arrive at taxable income, but not AGI. It's not allowed in determining net operating losses. Both itemizers and non-itemizers can claim it. Doesn't matter, and this is a key one. By statute, it doesn't matter if the taxpayer is materially involved in the business activity. What matters is that you've got an ownership percentage in the business. Now that is backwards from our normal way of thinking that I can claim a deduction if I'm materially participating. Technically, the statute does not say that. I want to see guidance from the IRS on that. What it depends on is whether the taxpayer has ordinary income. If you don't have any income, you can't get the deduction. All right. Skip that last one. Now that's a farm-specific one. I'll pass on that one for our purposes today. It's claimed after AGI. It cannot exceed 20% ordinary income. These are general points to begin with the exception for anything that's passed through to a patron from the co-op. You just get that, period. So the deduction provides no benefit unless the taxpayer has positive taxable income. Here are things it does not include. So if I'm in an S corporation and I have reasonable compensation, we back that out when we do our QBI computation. Which, let me make a point with respect to that. If you go to page 10, right beneath the note box, let me show you this illustration. I'm using a farm example here, but let me just illustrate that first point. QBI does not include reasonable compensation. Julie's a Kansas firm that anticipates generating $150,000 net income in 2018. Your QBI deductions will vary depending on the business structure or activity. Substitute in whatever business type activity you have. It doesn't matter for purposes of this illustration. Your business, you're anticipating generating $150,000 net income. Well, what should my business structure be to maximize my deduction? If she's a sole proprietor, in other words, Schedule F, net income $150,000. Tentative QBI is going to be $150,000. That would all be business income. See what I'm saying there? That's business income. That's going to be on your F or on your C for your non-farm business. Less half of SE or payroll tax. So we back that out of $10,135.80. So her net qualified business income is $139,864.20. Her QBI amount is 20% then of the qualified business income, which gets you a QBID of $27,927.84 if she's a sole proprietor. You're just going to take the bottom line of what your business income is for a sole proprietor. If you're an S corp, net income is $150,000. Well, what do you have to do in an S corp to avoid IRS snarking about your taxes. You gotta pay yourself reasonable compensation. Okay? So let's say that she pays herself a salary of $55,000. That's not QBI eligible. So QBI amount does not include reasonable compensation, as I mentioned on the screen. This is the impact. So you back that out, so her tentative business income then becomes $95,000. We subtract out half of the SE or payroll tax on that, which now is $4,207. Her net QBI is $90,792. 20% of that's $18,158. We just lost, what, $9,800 of deduction by being an S corporation compared to a sole proprietorship. Does that make sense? Let that one sink in. Now, we're only looking at one aspect of the entire realm of decision-making that goes into what type of entity should I be. We're just looking at the QBI deduction in isolation. What this points, though, is that the entire bottom line of your Schedule C business or your Schedule F business as a sole proprietor is business income that counts for purposes of the deduction. Once you form an S corp, you have to pay a reasonable salary. We have to back that out, which is going to reduce the deduction. So this is kind of the, some of the thought process that you have to engage in. Same thing, I could add a partnership in here. And we're going to basically get the same thing, because what we're going to do in a partnership is we're going to have guaranteed payments. We're going to back those out. Our deduction is going to be less than what it would be for a sole proprietor. It's going to be very comparable, not exactly because of the payroll tax issue. It would be very comparable to what we see in an S corporation. Okay? Questions on that? That's the point I'm making there, in terms of how mechanically how this works. Also, don't include capital gain or loss. Don't include any amount received from an annuity that's not in connection with a trade or business. Don't include speculative gains. If I'm a farmer and I'm speculating, the gains that I receive from speculation are not business income. The speculating that I'm doing must be related to my business. It has to be a true hedge. I'm offsetting price risk with respect to my business activity. So whatever my business is, if there's a market that I can participate in, if it's a true hedge, then that's business income. If I'm trying to reduce my risk associated with my business, then that would be business income. Otherwise, it is not. Okay, so as I said, for the sole proprietor, the entire bottom line of the F or the C will qualify. Self-employed health insurance, in terms of whether it's, you're going to have to pull out self-employed health insurance from your QBI computation for a sole proprietor. And I was not factoring that into the Julie example here. Yeah. Retirement contributions do not count as business income. You're going to pull it out. Yep. Initially, you're going to put it there, and then you're going to back it out. We think that's how the form's going to look. Again, I'm flying blind here with no form. I'm just trying to imagine in my mind the various lines. You're going to have a line up top, all your business income, and then you're going to back out all these excluded items, and those are going to be excluded items to get down to your QBIA, which then you would apply the 20% to. I'm thinking that's how the form is going to work. Believe me, it's frustrating to try to teach this with no guidance. I'm just based on the statute. All right, but these are all great questions. Okay, you have to net items with respect to multiple trades or businesses. If you have more than one business, you're going to do your QBI computation with respect to each business, and then you're going to net them. Income and losses appearing on various forms and schedules of your tax return. That's how it's going to be done. Okay, each trade or business will compute its qualified business income amount. That might be negative. In the balance of time that we have, let me just focus on examples here. The way I lay this out is to first tell you what qualified business income is, then the QBIA, what is the QBI amount. One thing I would point to on page 11, look at the first example at the top of the page has to do with hedges. Hedges are speculation. The second example is John and Jessica. They have a farm operation as a general partnership. Again, farming doesn't matter here. It's just they're in a general partnership together. Generates $100,000 of income from the business. John got a guaranteed payment of $110, so now the partnership shows a loss of $10. That's negative QBI, But if he was specially allocated the first 100,000 income, and then they split evenly all partnership income after that, all the farm income now is QBI. But the point, this is a workaround that particular rule. This could be viewed as an end run by the Treasury, and what I indicate in the note box next is watch for a regulation that says you can't do that. But as of right now, that's a big planning tool. That's a wide open door, I think. And that's one of the things we mentioned to the committees. Like, you guys realize you can do special allocations to get around that rule? Yeah, we do now. We're not responsible for writing the Treasury regulations, but we were told, anticipate something perhaps from the Treasury, just close that one down. Okay, that's a practitioner one to help you out on that one. Treatment of capital gain or loss, go to page 12. These examples on page 12 indicate that if you have sale of capital assets triggering capital gain, even though these are farm examples, my point here is the nature of the asset, if the gain is capital, that does not count as business income. So you have to back that out. I would imagine the form will be and include all the business income, even if this is a sale of a business asset. What I'm showing here is a sale of breeding stock. Well, that's a 1231 asset. That's part of the business. But you have to back that out. And so if all of your income is coming from the sale of capital assets in your business, you have no qualified business income the way they've written the rules. It has to be ordinary income. So the characterization of the gain matters. And that's what these examples show you on page 12. And then how you handle negative QBI, at the bottom of 12, if you have a negative amount, it's going to carry over to the next year, and it'll be factored in the next year's computation. Okay, then we get to QBIA. So we've computed what qualified business income is. We've backed out those items that don't count. Now we're down to our qualified business income amount on which we will compute the 20% deduction. That's the next step. That starts on 13. This is where you get the complicated formulas. Okay, so far it was easy. Now we have various thresholds. The tentative QBI for each taxpayer toward the top of 13 for each of the trades and businesses, if you have multiple ones, is the lesser of, so this is the overall limitation on the deduction. So now they've thrown in, okay, you get 20%, but it might be capped. It's never going to drop lesser than 9. It's never going to exceed 20. So it's got to be in that range. Remember what they're replacing. They replaced the 9% DPEP. So they want to make sure you get 9. So it's never going to drop below 9, but it's never going to exceed 20 of your qualified business income as that is defined, and it doesn't include capital gains. So the QBIA is limited to the lesser of 50% of the taxpayer's share of wages of the qualified business, or 25% of wages plus 2.5% of unadjusted basis of immediately after the acquisition of all qualified property. This is where the formula, the limitation becomes very complex. And I take you through some examples of that. The wages and investment limitation, if you keep your income, I'm kind of compressing the discussion here, toward the bottom of 13 and 14, if you keep your income from the business under 315,000 on a married filing joint return, then you don't go through these limiting factors. Or it's 157.5 on a single return. That's mentioned at the bottom of 13. So you ignore the 50%, the 25% plus 2.5% of unadjusted basis of property. You eliminate those cut downs if you keep your income from the business under 315,000 on a joint return or 157.5 on a single return. And that's what I then get into on the bottom of 13 over on 214 with a step-by-step discussion on 14. These are the steps as to how you walk yourself through this. This is what, for those of you that aren't practitioners, this is what your practitioner is going to have to deal with. Look at all the fun stuff that they get to have to do. No, not so much. Keeps you on your toes. Or you might just say, it's time to retire. I've heard that one too. So there are more of these examples explaining the wage and investment limitation on 15. In fact, the example at the bottom of 15, again, that's a name my son gave me. I changed it slightly to Ronald Chi. He gave me Ron Chi. You can figure that out, but nevertheless. Again, that's one of his more tame ones. But what those examples do that go through page 12 is illustrate that wages and investment limitation. And then the co-op rule, since many of you are not dealing with ag, the co-op rule starts on 17. The basic point of that discussion starting on 17 is that you do your computation for your deduction for your business. Then if you're also a patron of an ag co-op, whatever the co-op passes through to you in terms of their deduction, you get a claim irrespective of any limitation. You just claim it. And so that's what those, you just take it. You just add it to whatever your QBI deduction is without any limitation. There are numerous examples that explain that. I show you examples of dairy operations that have just income from sale of breeding livestock, no milk sale, and they won't get a cubic deduction unless they have something coming from a co-op, which they might. And the payment of W-2 wages. Wages don't count unless they are W-2 wages. Payroll tax has to be paid. So if we're paying wages in commodities, those don't count. Those are not W-2 wages for this purpose. Okay. And then on the last couple of pages, on 22 and 23, I give you a 10-step process for computing this thing. 10 steps, as I see it right now. Now that has morphed into 10 steps. When I started, I had it in 5, and I thought, no, I'm missing a couple steps. Now I've landed on 10, and this is just how you do it, as I see it right now. Okay? Now, I didn't get us bogged down into a bunch of that discussion. There's a lot of fine detail that's in that material that I did not cover. I skipped all the ag stuff, basically, for you. But at any time, and I think this may give us, let me ask how many practitioners do I have here that prepare returns? Okay. How many of you have done for your married clients, married filing separately? Do you do that very often? I think you may do it more now. Because think this one through. This is what I think might happen to you. If the taxpayer is well over the threshold, if one of them is, and one of them is under the threshold, you know, this 315, 157.5 threshold, you got one over because they each have jobs. One's got a business over here, another one's got a business over here. They would both qualify, they both have qualifying businesses. So you got one over the threshold and one's not. Maybe one is a CPA, an attorney, and the other one's got a flower shop or whatever the case might be. Okay, so you got high income, not quite as high income, so you got one over the threshold, one under the threshold. Think this one through. Consider filing separate returns. Let's say Paul is a W-2 employee with a $400,000 salary, working at a firm in Cedar Rapids. Patty, the wife, has her own little business, maybe a flower shop in town or whatever it might be, a specified service business, with a profit of $175. Married filing jointly is going to result, and I just did the math on this, married filing jointly is a total tax of $164 with no 199A deduction because they are at $575. They're over the 315 threshold, and there's a $100,000 phase out, so they're totally phased out of the cubic at 415. And so their tax would be on a married filing joint return 164 and no deduction. Now, if we do married filing separately, you're going to get a total tax of 160 because now you've ginned up, even though our rate structure is a little bit different, now we've ginned up a 199A deduction. And so by doing that, we save $3,800 for the couple. Think that one through. I think this is going to end up in more married filing separate returns when you've got one client that is got high income with a firm in Cedar Rapids or whatever the case might be, and you got the other spouse of that client. The spouse of that client has also another business of his own or her own. You want to do the math on this. You may end up, again, if you file married filing jointly, no deduction, total tax there, and you may be able to save a little bit of money by going married filing separately. Have you thought of that before? I think that's a likely result of what you're going to see with that type of clientele base. Now, there is minimal cost to prepare 2 tax returns. The software is going to do it automatically. Okay. will not work in community property states. You don't have to worry about that unless you have clients in Wisconsin. Are you doing any clients in Wisconsin? This will not work in a community property state because all the marital property is deemed to be owned equally. It's only going to work in states like Iowa, Illinois. The vast majority of states are not community property states. There's about 10 of them that are. The closest one is Wisconsin. So I want to throw that one out there. That's I think, an impact of this. Do I incorporate it as an S corporation? These are concluding comments here. Well, if I'm a sole proprietor, I have no wages paid and high income, then I might want to be an S corporation. So let's say John has Schedule F income, let's say he's a farmer, $750, no wages paid. He's over the limit, doesn't pay wages, and as you'll see in that discussion, he's not going to get a deduction. Well, if he becomes an S corporation and pays a $225,000 salary, the 199A deduction is now about $100,000, reducing taxes by about $35,000. Now, what I could see in this instance is an IRS challenge saying, kind of reverse of what their argument has been for years. Oh, your salary's too high. Now we're going to cut you down. And what they'll cut you down to, I would think, in this situation, is they're going to cut you down to the wage base. The 132 for next year, whatever the case might be, 128.4. So I would be armed for that battle. And it's reverse of what we fought IRS for a number of years. They're always trying to get, the incentive in S corporations is keep your salary down. Now the incentive might be to increase it to gin up a deduction. Well, IRS may push down on that. So some things to think about there. Okay, we talked about that. Reducing S corporation wages may be a strategy too. Maximize retirement plan deduction. Okay, Betsy and Tom have an SSB, which is a specified service business, that nets $439 of income, so they're over the $315 plus the $100,000 phase out. They're over $415, they don't get a deduction. So one thing you might do is create a 401k plan and dump $100,000 into it. That's going to reduce AGI by $100,000. It's going to create a $63,000 deduction. Cool. Those are just some things to think about as you talk with your tax plan, tax practitioners. All right. Convert from an S to sole proprietor. Mary has an S corporation, that's $100,000. After paying her $100,000 salary, qualifies for a $20,000 199A deduction. If she's a sole proprietor, then the deduction increases close to $40,000, as I showed you in the prior example involving jewelry. So there are a number of options. There is no one size fits all. Okay, that's for sure. Hopefully you found the discussion in the past 2 hours helpful and not just a brand new fog to walk around in. Yes, no? Okay. I'll turn it back to Hills Bank or LattaHarris, whoever, if you have announcements at the end, whoever wants to say something. Otherwise, there's my contact information. Feel free to send questions anytime you have them. I think we're all learning together as we go through this, and I'd be interested in knowing what questions you have. Okay. Thank you very much.
Yeah, let's give Roger a LattaHarris and Hills Bank. Thank everyone for coming out for a couple hours, spending a couple hours of your morning with us. Like Roger said, I hope you found it useful, and certainly a lot of things to think about as we head back to work for the day. Thank you again. Have a great day, everyone.